This is for educational purposes. There's nothing being solicited. I am a investment advisory representative with Financial Network Investment Corporation, and securities and investment advisory services are offered through Financial Network Investment Corporation. Volatility is very, very detrimental. This is an example of two investments. The first investment has a 12% two-year average return. It made 50% in the first year. $100 went to $150. In the second year, it lost 26%. So $150 went back down to $111. And investment B, if you take the 2 years, minus 10 and 30, it's got a 10% average 2-year, but $100 losing 10% goes to 90, and then making 30 goes to 117. And if you think about this, the upside on investment B wasn't as high as the first one, and the downside wasn't as low. So it is not impacted by risk, what we call risk drag, as much. And so you actually can end up with a higher ending value if you can control volatility, if you can keep it within a tighter band. Now, in this example, the reality is that what you see here is not funny money math. It's the difference in the arithmetic mean and the geometric mean, because when you average over 2-year periods, you get a different number if you take the average of each year and add them together. But this is a great way to illustrate that if you have to be aware of volatility. Volatility is just as big a threat to you achieving your long-term goals as is underperforming the market. The S&P 500 index is a widely recognized measure of the U.S. stock market performance. It is an unmanaged index of 500 common stocks chosen for market size, liquidity, and industry group representation, among other factors. The Barclays Capital U.S. Aggregate Bond Index is an unmanaged index that covers the U.S. dollar-denominated investment-grade fixed-rate taxable bond market of the SEC-registered securities. The index includes bonds from the Treasury, government-related, corporate, mortgage-backed securities, asset-backed securities, and collateralized mortgage-backed securities sectors. Barclays Capital U.S. Intermediate Government and Credit Bond Index is an unmanaged index that includes U.S. Treasuries, government-related issues, and investment-grade U.S. corporate securities with remaining maturities of 1 to 10 years. Barclays Capital U.S. Long Government Credit Bond Index is the long component of the Barclays U.S. Government and Credit Bond Index and is a widely recognized index which features a blend of U.S. Treasury, government-sponsored, U.S. agency, and supranational mortgage and corporate securities limited to a maturity of more than 10 years. The Barclays Capital U.S. Corporate High Yield Bond Index is an unmanaged index that covers U.S. dollar-denominated, non-investment grade fixed-rate taxable corporate bond market securities. Citigroup 1-month Treasury Bill Index measures monthly return equivalents of yield averages that are not marked to market. This index consists of the last 1-month issues. Returns for this index are calculated on a monthly basis only. The Consumer Price Index is an inflationary indicator that measures the change in the cost of a fixed basket of goods and services, including housing, food, electricity, and transportation. The Sharpe ratio is a measure of historical adjusted performance calculated by dividing the fund's excess returns by the standard deviation of those returns. The higher the ratio, the better the fund's return per unit of risk. Investors cannot invest directly into indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and/or fees and expenses associated with investing.